From the opinion pages of the Wall Street Journal, this is Potomac Watch.
First Citizens Bank shares buys the assets of failed Silicon Valley Bank in a transaction negotiated by the Federal Deposit Insurance Corporation, and markets breathe a modest sigh of relief. We'll take stock of the state of the banking panic in the third week since it began. Plus, Minneapolis Federal Reserve President Neel Kashkari says the financial tumult makes the odds of a recession that much more likely. Welcome, I'm Paul Gigot with the Wall Street Journal opinion pages, and I'm here with my colleagues Kim Strassel and Joe Sternberg. Welcome to you both. Boy, how I would like to have been a First Citizens Bank shareholder this morning. The FDIC finally found a buyer for the assets of Silicon Valley Bank. Cost the FDIC insurance fund about $20 billion to cover the losses in a loss-sharing agreement, according to the FDIC. That's about 10% of the money in the fund. So that's a substantial chunk of that bank safety net. Second, First Citizens really comes out looking like it has made a steal. The stock soared today 36% the last I looked. So that's astonishing. And it looks like, Joe, that's because of the terms that the bank, First Citizens, managed to get here for this purchase of the remaining assets. Really a sweet, sweet, sweet deal. What do you think?
Yeah, I mean, any deal is fabulous if you can get the taxpayer to shoulder a lot of the risk in it. So, I mean, that's terrific work if you can get it. And it seems to be what has happened here. Because, I mean, what First Citizens seems to be getting are the deposits from Silicon Valley Bank. And they also are getting a lot of the commercial loan portfolio. And there is some risk associated with that, although they're getting them at a discount with a commitment from the government, ultimately the taxpayer, to backstop some portion of the losses on those commercial loans, which, remember, are primarily to very risky tech startups. And, then also additional lending from the government to sort of help grease the wheels of the deal. And I mean, this is a classic government orchestrated bank bailout 101. And this is exactly what happened with Credit Suisse a week ago, where in that case, it was the Swiss taxpayers who were expected to pony up billions of Swiss francs of guarantees for UBS, which was buying Credit Suisse in that transaction. And the cherry on top is that we are now creating a bank from the merger of these two that will be one of the 25 largest financial institutions in the U.S. So we now get a brand new member of the too big to fail club.
Well, the other thing, Kim, in this that strikes me is we're now, 17 days into this panic. And on that first weekend, where right after FDIC took control of Silicon Valley Bank on Friday, they had an auction and they had bidders. But the FDIC said, no, we're not going to take those bids. And one of the main reasons my reporting suggests that they didn't was because they were concerned about consolidation. They were concerned about hedge fund private equity buying the bank. They only wanted certain buyers. And I think if they had accepted one of those offers at the time, it would have been a lot less costly to the FDIC fund instead of 2 weeks later when you've had further deterioration and you have to go hat in hand to some of these banks saying, please, please, please buy it, and here's what we're going to give you in order to make that purchase. The cost went up, cost of taxpayers went up, and we're ending up with a consolidated bank anyway, as Joe suggests.
Right. As Joe said, it's going to make it among the top 25, so we still have a big new giant out there, only with a lot of taxpayer assurances behind this, because not only is the FDIC going to agree to share in any losses, I thought it was notable, it said, also any gains. We can talk about that a little bit. It's more likely to be losses. But also, this is getting financed with a $35 billion loan from the FDIC, a $70 billion line of credit. Among the deposits that First Citizen is getting is about $56.5 billion. And that just shows you how badly things had gone at SVB, because prior to its collapse, it had $175 billion in deposits. So that's how much people have pulled out of the bank. And I think that this is really an interesting question, though, know, too, because if you look at First Citizens, it is a very different business model than what SVB did. This is a family-owned bank. I think it's in its third generation of the same family running it. It's based in Raleigh, North Carolina. This is going to be a big new step for it into a California market, but also, as we have talked about, SVB had a very unusual business model where it was loaning a lot to these tech startups, some of them very uncertain bets. And one thing that hasn't really been explained is how a bank completely outside that orbit now steps in and tries to make a go of that. Maybe it does, but I think what it puts a light on is the possibility that taxpayers will end up maybe taking some more losses on this or problems. So instead of an auction, as you said, Paul, where people who really, really wanted this and might really have understood SVB and been better positioned to have managed the fallout from this, I mean, we're going to get this kind of untested situation here because the FTC had to go asking for somebody to step in.
The Federal Reserve president for Minneapolis, Neil Kashkari, was on the airwaves this weekend saying that the banking system is sound, stable, no worries, mate. That's what he's repeating the line that Fed Chairman Jay Powell has offered, as well as the Treasury Secretary Janet Yellen. But, Joe, does that give you great comfort here? Now, 17 days into this, and we've had at least 3 big bank closures. Last Friday, we had a big run on the share price of Deutsche Bank. The Fed seems to be concerned enough that somebody leaked over the last couple of days that it may have to expand its super-duper discount window that it offered the new term facility in the wake of the Silicon Valley Bank failure that lends mid-sized banks in particular money against their bad underwater long-duration interest rate risk and those bonds. And they lend it at par, which means that the banks, maybe some of those bonds may be only worth 70% on the dollar. So you end up with that maybe being expanded. They don't say how it could expand, but that suggests that all is not well.
Yeah, I think that we're still in the point where the Fed is very anxious to suggest that this is all down to bad management at a handful of banks. And in fact, the vice chair for supervision, Michael Barr, was testifying in the Senate today about some of the supervisory problems. And his argument, first and foremost, is that this is a management problem. I mean, the difficulty is that there's no reason to think that that's true. I mean, ultimately, the thing that these banks have been bad at managing, particularly bad at managing, is this risk that is created by rapidly rising interest rates after an environment where interest rates are unnaturally low for an extended period of time. But the problem is that everyone has been playing in that sandbox for the past decade. So, yes, I mean, sort of the low-hanging fruit here as banking problems go will be the banks that might have been particularly poorly managed and particularly not alert to the danger that this rapidly shifting environment posed as the rates have started going up over the past year. But that's not going to be an unusual problem because they have been all operating in the same environment for such a long time. So I think the issue is going to be moving forward, how deftly will bank management be able to sort of claw their way out of this interest rate environment as the broader economy does start changing in that way. But I'm not, unfortunately, very confident that the problems are going to end up being limited to only a couple institutions.